Recessions don't just create challenges, they create opportunities. If you've ever wondered how to turn a downturn into a wealth-building moment, this is the video for you. Welcome to part 2 of our series on recession-proofing your life, where I'll show you how to invest smartly during an economic slump. This is Money Moves, where we help you build wealth, make smart decisions, and keep making those money moves. Let's jump in. Here's the truth. Every recession has winners and losers. And you know what? I'm going to show you how to be one of the winners. See, during economic downturns, assets like stocks, real estate, even entire businesses, they go on sale. It's like Black Friday, but for your financial future. Now, I know what you're thinking. The market is crashing, everyone's freaking out. Why should I invest? And that's the difference between those who get rich during recessions and those who don't. It's all about perspective. Think of it like this. When a luxury car goes on sale, do you panic and run away? No! You jump at the chance to own something amazing at a fraction of the price. That's what smart investors do during recessions. They see opportunity where others see fear. History backs this up, guys. Every single recession, without fail, has been followed by a bull market. It's like clockwork. The market goes down, the market goes up, and those who bought low during the downturn, they're the ones laughing all the way to the bank. Now, I'm not saying it's easy. It takes guts to invest when everyone else is hitting the panic button. But trust me, the potential rewards are massive. We're talking life-changing wealth here. So, if you're ready to turn this recession into your financial springboard, stick around. In this video, I'm breaking down my proven strategies to help you make smart investments and come out ahead when the dust settles. Alright, let's talk blue chip stocks. These are the heavy hitters, the companies that have stood the test of time, weathered countless storms, and come out stronger. Think Coca-Cola, Johnson & Johnson, companies that have been around for decades, paying dividends like clockwork. Why are blue chip stocks great during a recession? Simple, they're built to last. They have strong financials, diversified revenue streams, and a proven track record of navigating tough economic times. Now, I'm not saying their stock prices won't dip during a recession, everything does, but they tend to be less volatile than smaller, more speculative companies, and that's crucial when you're trying to protect your capital. Plus, many blue chip companies pay dividends. This means that even if the stock price is down, you're still getting paid just for holding onto the stock. It's like getting paid to wait for the market to recover. Think of it like owning a rental property. Even during a recession, people still need a place to live, right? So, you're still collecting rent even if the value of the property dips temporarily. That's the power of dividends. Now, how do you find these rock-solid blue-chip stocks? Well, you can do your own research, or you can look at established indices like the Dow Jones Industrial Average or the S&P 500. These indices are composed of some of the largest, most stable companies in the US. Now let's talk about diversification. This is crucial, especially during a recession. You've probably heard the saying, don't put all your eggs in one basket. Well, it's not just a cute saying, it's financial gospel. Look, no matter how much you believe in a particular stock or asset class, you never want to have all your money tied up in one thing. Why? Because if that one thing tanks, you're toast. Think of it like this. You wouldn't bet your entire life savings on one hand of blackjack, would you? No way. You spread your bets, hedge your risks because you know that anything can happen. That's what diversification is all about. It's about spreading your investments across different asset classes, stocks, bonds, real estate, maybe even some gold or other commodities. This way, if one asset class is down, you've got others to cushion the blow. Now, how much should you allocate to each asset class? Well, that depends on your risk tolerance, your time horizon, and your financial goals. There's no one-size-fits-all answer, but a good rule of thumb is to have a mix of stocks for growth, bonds for stability, and real estate for income and appreciation. And remember, you can always adjust your asset allocation as you get older, as your risk tolerance changes, or as market conditions evolve. Diversification isn't sexy, it's not going to make you rich overnight, but it's the foundation of a sound investment strategy, especially during turbulent times. Let's talk real estate, one of my favorite asset classes, especially during a recession. Now, I know what you're thinking, the housing market is crazy right now. How can I possibly invest in real estate? Here's the thing. Recessions often lead to corrections in the real estate market. As the economy slows down, people lose jobs, they might have to sell their homes, and that creates opportunities for savvy investors. Think about it. When demand goes down, prices tend to follow. This means you can potentially snag a great deal on a property that would have been out of reach during a booming market. Now, I'm not saying you should go out and buy the first distressed property you see. You still need to do your due diligence, research the market, and make sure you're getting a good deal. But if you're patient and strategic, a recession can be a fantastic time to get into the real estate game or expand your existing portfolio. And remember, real estate is a tangible asset. It's not some abstract stock ticker on a screen. It's a physical property that you can touch, feel, and potentially even generate rental income from. Now, I know what you're thinking. I don't have hundreds of thousands of dollars lying around to buy a property. And that's okay. There are other ways to invest in real estate without breaking the bank. One option is REITs, or real estate investment trusts. REITs are companies that own and operate income-producing real estate, like shopping malls, office buildings, or apartments. You can invest in REITs just like you would invest in stocks, and they often pay dividends, providing you with passive income. Alright, let's talk about cash. I know cash isn't as exciting as stocks or real estate, but trust me, during a recession, cash is king. Here's why. When everyone else is panicking, selling their assets at a loss, you, with your cash reserves, get to swoop in and scoop up those bargains. It's like showing up at a fire sale with a wad of cash. You have the power to negotiate, to get incredible deals because sellers are desperate. Now, I'm not saying you should hoard cash under your mattress. You still want your money to work for you, to outpace inflation. But having a healthy cash cushion gives you options. It gives you flexibility, and it gives you peace of mind during uncertain times. Think of it like an emergency fund but for your investments. When the market throws you a curveball, you're ready to swing. Now, how much cash should you keep on hand? Well, it depends on your individual circumstances, your risk tolerance, and your financial goals. But a good rule of thumb is to have at least 3 to 6 months worth of living expenses in a high-yield savings account. This way, you're covered in case of job loss or unexpected expenses. And then, you can allocate a portion of your portfolio to cash equivalents like short-term bonds or money market funds. These investments won't make you rich, but they are relatively safe and liquid, meaning you can access your money quickly if you need to. Alright, let me tell you a story about a guy. He's just a regular guy, worked a 9 to 5, wasn't born with a silver spoon or anything. But he understood the power of playing the long game, especially during a recession. Back in 2008, when the financial crisis hit, everyone was freaking out. People were losing their jobs, their homes, their retirement savings. It was a scary time. But he saw opportunity amidst the chaos. He knew that recessions, as bad as they are, they don't last forever. He understood that the market moves in cycles, and that what goes down must eventually come back up. So, while everyone else was selling their stocks in a panic, he was buying. He was investing in index funds, dollar cost averaging, buying a little bit every month, regardless of what the market was doing. He also decided to get into real estate. He found a duplex that had been foreclosed on, got it for a steal, and rented out both units. The rental income covered his mortgage and then some, and the value of the property has more than doubled since then. Now, he didn't get lucky. He wasn't some kind of financial genius. He simply understood the fundamentals of investing: buy low, sell high, and stay the course. He knew that recessions create opportunities, and he was prepared to capitalize on them. He didn't let fear dictate his decisions. He stayed focused on his long-term goals, and he was rewarded for his patience and discipline. Today, his portfolio is worth over $1 million. He's living proof that you don't need to be a Wall Street whiz to build wealth. You just need to have a plan, stick to it, and be willing to play the long game. Recessions aren't the end. They're the beginning of new opportunities, and remember, the best time to invest is when everyone else is selling. By following these strategies, you'll be well positioned to not just weather the storm, but to come out stronger on the other side. In part 3, we'll dive into building passive income streams during tough times. Don't forget to hit like, subscribe, and as always, keep making those money moves.